Welcome to CPE Voices, our series through which we present insightful discussions among industry thought leaders, moderated by our editorial team. During this mid-year 2025 outlook, we'll be addressing key questions that may be top of mind as we head into the second half of the year. I'm Suzanne Silverman, Editorial Director of Commercial Property Executive, and I'm here today with 5 leading industry experts: Mark Zandi, Chief Economist at Moody's; Laura Rapaport, Founder and CEO at Northbridge; Michael Underhill, CIO at Capital Innovations; Michael Acton, Head of Research and Strategy for North America at AEW Capital Management; and Robert Durand, Executive Vice President of Finance at KBS. We're recording this session and it will be available for later viewing. In addition, we're going to leave some time at the end to answer your questions, but please feel free to submit them at any time during the webinar. Unfortunately, Mark Zandi is not able to stay for the Q&A, but the rest of the panel will be available to address your questions. And thank you to those of you who submitted some in advance. We'll try to get to as many as we can. First, though, Mark, could you set the stage for a discussion?
Sure, Suzanne. Thank you for the opportunity to participate today. Thanks for the hour to speak. No, only kidding. I've got 5-7 minutes. And it's great to be with this panel. Some good old friends. Very much good to see everyone. So thank you. Let me just quickly preface my remarks by saying, I've been a professional economist for, hard to believe, 35 years. And there are a few times in that period when I've been as unsure about the economic outlook as I am today. There's the great financial crisis, the GFC, obviously a very uncertain time, the pandemic being another. But outside of those two periods, I'd have to say this is about as uncertain a time as I've experienced in that 35-year period. But having said that, I'll take a crack at it. My sense is that the economy, when I say the economy, I mean the U.S. economy, the national U.S. economy, it's going to feel a little uncomfortable for the next 12 months, the year dead ahead. Um, and it goes to economic policy. And I'm going to try not to sound political. I'll do my best, but I do think that, a policy here has a big role to play in how the economy is going to unfold. And at the top of the list of policies that's going to shape the economy going forward are the tariffs. And just to give you a sense of things, uh, uh, after all the ups and downs and all arounds, it looks like the effective tariff rate across all countries and products is going to come in around 15%. It's going to change a bit here as we get some agreements with different countries around the reciprocal tariffs. We'll see some increases on sectoral tariffs for pharmaceuticals and for chips, but when you add it all up, I think 15% is kind of roughly where we're going to land. And that compares to just over 2%, when we started the year. And here's a good rule of thumb. For every percentage point increase in the effective tariff rate, that will increase inflation or prices as measured by the consumer expenditure deflator by 10 basis points. So if you do the arithmetic, 15% effective tariff rate minus 2 times 10 basis points, that means inflation is going to be over a percentage point higher by this time next year. So instead of 2.5% inflation, which is roughly where we are today, closer to 3.5 to 4%. Another good rule of thumb, every percentage point increase in the effective tariff rate will reduce real GDP by about 8 basis points over the subsequent year. So again, do the arithmetic and add it all up. We're going to go from growth that's close to 2%-ish. That's kind of roughly where we've been, to closer to 1%, by this time next year. And 1%, that's not a recession. So I think we'll be able to avoid an economic downturn. But that's going to feel, as I said, uncomfortable. It's below the economy's potential. And that means job growth is going to slow. Just to give you a few numbers there, if you go back last year, average monthly job growth was 160, 170K per month. It feels like, abstracting from the vagaries of the data, we're sitting around 100K, a little north of that right now. And if you told me a year from now we're closer to 50K-ish, I'd say, that I'd count on that. And that means unemployment is going to rise. The unemployment rate today is just over 4%. I suspect, 12, 18 months from now, when unemployment peaks, it'll be closer to 5. The other policy I'll just call out is immigration policy, the restrictive immigration policy, and that has many dimensions. And clearly, the surge in immigration we saw back a couple, 3, 4 years ago created lots of cost to communities across the country. So it was very difficult for many communities to adjust to that. But one of the benefits of it was it added very significantly to the labor force, at a time when the Federal Reserve was working really hard to slow things down and cool things off, and that really helped do that and forestalled even more aggressive rate hikes by the Fed, and arguably is one reason why we were able to avoid a downturn during that period that many economists anticipated. Uh, Now immigration has been shut down. Any flows from across the southern border, they're not happening. That began a year ago with Biden's executive order on asylum seekers and continues through to the Trump administration. Labor force growth is slowing very rapidly. In fact, if you look at the growth in the labor force for the foreign born, it's actually now starting to decline compared to growth of 4 or 5% a year ago. And that means that with lower labor force growth, the economy simply can't grow as quickly as it has in the past without generating higher inflation and higher interest rates. So immigration policy is also going to play a role. I do think we'll be able to get through this without a recession. The economy came into this period, very performing very well, and it was quite resilient, and I think that'll continue to shine through. But again, I say that with not a whole lot of confidence. I want to end by just calling out two potential risks. There's upside risk here, but I'm going to focus on two downside risks, given that when you're growing more slowly, you're more vulnerable to anything else that could go wrong. One has come to the fore most recently, and that's the high potential for higher oil prices. Fortunately, they're back in. Looks like the hostilities with Iran are abating, but I think it's fair to be nervous that there's a lot more script to be written here, and we could see oil prices rise again. And that would be problematic in the context of the tariffs and inflation and immigration policy, which is also going to lead to higher costs and higher inflation. The other, and I'll end, is long-term interest rates, bond yields. The piece of legislation making its way through Congress now, the so-called reconciliation bill, has lots of moving parts. When you net it all out, it's kind of a wash with regard to its impact on the deficit, but all the direction of travel was already for large deficits going forward. That's going to continue, and our debt load will continue to rise. And I do think we're getting to a place where, that at some point bond investors are going to have a real problem with that, and we could see, interest rates rise to a very significant degree. That's not my baseline. I expect, we'll be able to get through with 10-year yields kind of sitting around 4.25 or 4.5%, but I think I'd prepare for the possibility for much higher interest rates. So bottom line, it's going to feel a little uncomfortable, but at the end of the day, with a little bit of luck and some reasonably good policy making, we'll be able to get through without an economic downturn. So with that, Suzanne, I'll turn it back to you. And I will say I did have a deck. CPE has the deck. They feel free to distribute it to folks. But they'll just illustrate the points that I just made. So thank you, Suzanne.
We will do that. And thank you so much, Mark. Your insights are always very valued. You ended on a bit of an up note, so that's a nice transition into our discussion.
That wasn't my intent, Suzanne.
Well, you said you don't think we'll go into a recession.
Oh, there you
that,
go.
To me,
Okay.
sounds
Yeah,
like an
okay.
up note.
Okay. There you go.
I'll take what I can get. Well, let's go into discussion with the panel and get some more perspective on how all of this relates directly to commercial real estate. And Laura, maybe you could start us off and let us know how you expect commercial real estate to perform in the second half of the year. We can't hear you. Or if somebody else, Mike,
Sure.
if you
Yeah,
wanted to jump in now.
yeah, I'd be happy to, Laura. Real estate as an asset class moves a lot like an ocean tanker. The captain puts the turn signal in, and it takes a long time before you see the boat changing direction. real estate started to change direction about the middle of last year. Returns turned positive. We've had 3 quarters in a row of positive returns so far. Almost all of that return has come from income, not capital appreciation. I think that continues in the second half of the year. I think we continue to have positive total return for real estate, but more and more of it will start to come from some small write-ups in value, small capital appreciation.
Laura, did we get your sound yet? No. Okay. Does anybody else have anything to add, or we could keep going then?
I would probably second what Mike was saying. I think we've been seeing improvements in general in the cash flows. I think the capital markets haven't quite gotten all the way back to where they were. I don't know that they will get back to where they were in the heyday, but it has been positive baby steps along the way. I think and the capital appreciation piece should start coming back. I mean, we're a little more heavily weighted in office, and we definitely saw a big turn in the office markets starting kind of second half of last year, third, fourth quarter, and that continued to the first half of the year. And we felt really poised for kind of some good capital recovery in that space. But with the April Liberation Day announcements, the tariff risks, and now a lot of other additional risks, I think there's been a little bit of a hesitation on the part of investors to make big bets. But I think that they had been queuing up to make some big investments and turn things around, and that's given people a little bit of pause. But hopefully that they set that aside in the second half. We continue that momentum.
So, Rob, what are your biggest concerns for the second half?
Sure. So I think my biggest concern is that we end up in this, because of all the discomfort that Mark was talking about, that it's going to be kind of a bumpy road economically. It's very difficult to make aggressive moves in a market when you have that kind of background behind you. At the same time, it also creates a lot of great opportunities in being first mover, where others are maybe a little bit afraid or a little shy about kind of some of the macroeconomic impacts. So I'd probably say we have this continued sort of lack of conviction in the market, and people kind of wait for others to kind of lead. But I still think there's enough momentum to probably push that forward, just because of the amount of capital that I think wants to get in, and is just kind of waiting for the right time to do that.
Does anybody have additional concerns they'd like to add to that?
Can you hear me now?
Yes.
Okay, great. So happy to add to what's just been said, I guess maybe taking a slightly wider lens, which is kind of echoing similar sentiments. I mean, we expect commercial real estate to remain challenged, however, increasingly active in the second half of the year. And from our perspective, we hear about this maturity wall, particularly in the office sector, where there's a tremendous number of loans coming due over the next 3 years. They were originated in a lower interest rate environment, which until, from 08 to 22 was, nearly a zero interest rate environment, spurred a lot of the real estate investment that's resulting in the market now stabilizing at a higher interest rate. So you have $1 trillion nearly of maturities this year, next year, culminating in $1.3 trillion in 27. With that, you also have property values that have dropped, and traditional lenders who have tightened underwriting and either pulled back or removed themselves from the market entirely. And so that shortfall is really creating essentially an opportunity and a hole of nearly $570 billion to pay off these existing debt obligations before even talking about some of these new originations. And so this is where we're seeing the rise of private credit actually stepping in to fill that gap, and in many ways solving some of the problems that were just alluded to in terms of the different sectors and the different elements that actually make the value and the interest in the environment, particularly for real estate. So there is a lot of capital for private credit, and what we're also seeing is that there's a tremendous interest, and this goes to the increasing demand and the latter half of this year, because well-located assets, strong sponsors, strong market fundamentals, that's actually had the tremendous amount of capital on the sidelines for that. And so we're actually seeing some sectors outperform: multifamily, industrial, well-located, performing hospitality, Class A office in the right markets, data centers. These are all assets that we Northbridge see across the country is really having tremendous demand. And so it kind of comes as a tale of two types of properties, those who have these fundamentals and are performing, and therefore have the capital interested in investing, and those that are not and are a little bit more challenged, whether from being built in a lower interest rate environment, whether for having other market fundamentals. Certainly the tariffs, certainly inflation, all of the volatility in the market is adding to uncertainty and challenges. In particular for office, one thing that we're also seeing is there's a lot of press about office to residential conversions. I have a slightly different view than most, but before I share that, I think one of the things that's interesting that's adding to this is a lot of the noise around the amount that's being converted. And what's interesting is for the first time in 25 years, the US office supply is actually shrinking. And in fact, in 2025 alone, there's roughly 23 million square feet that is either being removed or repurposed. And while that is a very meaningful number in general, if you put that in the context of the 97 billion square foot national office market, it's only a few basis points. So then it really becomes the same way we look at real estate, and we're seeing this kind of tale of have and have nots, the market in particular, and the asset in particular. And for that, this is my view, not all buildings are created equal. The one thing you can't move about a building, it's location. And so does it have the right elements in order to be converted? The right floor plate, light and air? Is it an area that either is currently desirable for residential or might be in the future? Does it have a floor, the right egress, and all the elements that go there? One of the things that is particularly challenging is in a building that you're building ground up, you have challenges, of course, in construction, but you know what you're building. In a building that you're renovating, one of the biggest challenges is you don't know what's behind the walls, and you can have the most exceptional consultants, well-planned project team, but until you open some of these walls of 100-year-old buildings, it's anyone's guess as to what's really truly there. And there's a lot of site conditions that you need to deal with. So you really never know what you're getting in this case. And so one of the things that we're seeing a potential for is repurposing office for residential. But I look through that lens with a very strong asterisk of not all buildings can be repurposed to office or padel court. And sometimes buildings will be taken down or buildings will be improved. And so that goes to, to rates. And, what we saw from Powell today announced that they're holding and likely cuts, towards the end of this year, and then kind of echoing Mark's sentiments. The inflation continues to be a concern, whether as a renovation or when buying, and the general fundamentals. But I think that as we get more certainty on some of these other market forces and the noise quiets, that will create clarity, and the clarity will improve investor sentiment. So while there are significant headwinds, sticky inflation, trade-related cost pressures, geopolitical uncertainty, there's a number of things that could change and continue to make this a better half of 25.
Okay, so you touched on quite a number of property types that you were pretty bullish on. I think they were kind of the usual suspects that have continued to be the better ones. Michael Underhill, do you have any other thoughts on that? Are there any particular areas that are showing surprising promise or some sign of turning around?
Yeah, Suzanne. So I always have opinions. That's a good thing. I'm one of those grumpy bond guys. I've been doing this for a while. You look at bullish sectors, right? There's several sectors showing strong momentum in 2025. Think about energy transition and renewables. It's driven by federal incentives, global decarbonization, clean energy. You look at grid modernization, battery storage, et cetera, right? That's just within the energy transition, renewables, digital infrastructure, data centers, fiber networks, edge computing hubs, AI adoption, and rising data demand. And then think about what's going on with policy, and just taking a look at top down on policy, right? Advanced manufacturing. So think about onshoring trends, CHIPS Act, all the incentives that are sort of fueling semiconductor fab labs in places like Arizona. and all the related industrial assets. And then you take that and compare it or square the ledger with healthcare and life sciences, right? You've got aging demographics, biotech innovation, and the demand for highly specialized facilities and R&D campuses. You've got an opportunity set there within that ecosystem series of food groups. It doesn't look all that bad. It actually shows some decent momentum in 2025. Conversely, you look at just some of the bearish sectors, right? It's traditional office. And I think it's been echoed by my co-panelists here. It's still under pressure. Office delinquency rates could exceed 14% by 26, up 11% since late 24. Hybrid work environment, tenant downsizing, oversupply. And you look at markets. I was just in Texas last week. So think Austin, San Francisco. I'm going to be there in 2 weeks. Those are dragging in terms of performance. So that's, I'll give you the short version of the grumpy economist there and bond guy, but I think that's what we've seen just 30 seconds in a box stop.
Okay. Mike, Acton, how much do you see federal policy decisions impacting the industry? And well, let's start with that.
Well, I mean, there's a lot there, right? There's a big bag of policy going on in DC right now. Mark touched on some of it. Obviously, tax policy, spending policy, how much we're going to borrow, that all impacts interest rates, ultimately impacts the value of our assets. There's other things that are happening that don't get quite as much press coverage, certainly not in real estate, but have real impacts right away. Things like the crackdown on foreign students coming to study here. There's 1 million plus students in the United States from other countries. They concentrate in places like where I'm sitting today in Boston, and it's an important driver of the local economy. They rent apartments, they buy things, they have jobs, all those sort of things. The sort of the negative atmosphere that's been created around federal funding of basic research, science, medical research, all that happens at universities, and again, places like Boston are right at the epicenter of all of that. So we're really concerned about what federal policy does. It can impact the income side of properties, of course. The things I just described do that, but it can also impact the capital market side of it. If the federal government just keeps running amok in terms of borrowing and pushing things out into the future, that's putting pressure on yields to stay higher for longer. And I don't think anybody on this call really wants higher yields for longer. We'd probably all love some yield compression.
Yeah. Let's talk some more specifically about the investment market. Michael, generally speaking, when do you see the volume of CRE investment picking up?
Big picture. I don't know which Michael Underhill, or doesn't matter.
I'm calling you Mike and him Michael, but you can both answer.
Okay,
go ahead. You go first.
Right, I'll start. Yeah, I'll be brief. I think the thing that's sort of the switch turning is when property yields are finally above borrowing costs. I think that's when transaction activity really picks up for real for this cycle.
Yeah, so I'll chime in. So I look at volumes, and then we'll start top down at some of the just themes, right? You look at resilience amid some of the uncertainty. Despite all the macroeconomic uncertainty, global real estate markets, they're showing signs of resilience, pockets, albeit it's supported by low supply in some spaces, growing income potential. There's a shift towards income growth, and returns are driven increasingly by income and income growth rather than capital appreciation. And in the operational real estate sector, so think logistics, data centers, living spaces, they're getting traction due to some of the structural demand and the demographic shifts. And I'll even sort of drill down a little further, right? If you look at the regional highlights, there's a cycle that's emerging for early movers, and to the point, you look at the 10-year. I was pulling up some of the data on the 10-year, and you look at the spreads, right? They haven't been like this since 2021. And you look at the gap between the 10-year and the 5-year, it's the widest since 2021. And you look at that differential, it could be spelling stronger growth, which I think that's questionable. It could be spelling higher inflation, which I've been in that stagflationary trajectory camp. And if you look at some of the forecasts on the 10-year for the Treasury yield, it's around 380 to range bound 4 by September 30th, right? So it's a modest decline from here. I think there needs to be a little bit more market clearing. You need the bid-ask spread to come in, but there are regional areas, geographies I'm happy to go through. I don't want to pull all the air out of the room, but there are areas, sectors, and geographies, I think that are critical to take a look at, because there is, under the surface, there are some interesting deals to be had.
Rob?
Yeah, I was going to add that I liked Mike's comment about the negative leverage problem. I think that's a really tough one to overcome, particularly in the hotter segments in the multi and industrial space. It makes acquisitions very difficult. It makes your underwriting very difficult to make a buy with a conviction at that level and have to prove to an investor and support the yield conclusion at the end of the day without saying something like cap rates are going to drop or rents are going to grow by an abnormal amount, which is what saved the market, I think, in a lot of those spaces over maybe not the last 2 years, but maybe the 5 or so years before that. I don't think anybody would have underwritten double-digit rent growth in the multifamily space if you're going to present an investment thesis. So I think we need rates to come down to really kind of juice up the heat, if you will, in the market, and that would probably be a good sign of when things start to pick up. I think the other piece is lenders are still very reticent to make big bets. They're very cautious, as they generally always are. But here there's it's in the recent memory of the challenges. You have the debt maturities coming up across the entire sector, regardless of property type, that have to be addressed. A lot of those construction loans on multifamily deals that were done 2-3 years ago, that was a 4.5, maybe 5 cap exit market, and now that's probably a 5.5, 6 exit. So you have to absorb some of those changes, and I don't think we've had the rent growth that we had prior to that to kind of bail those out. So it's not just office that's got challenges. There's some other newly built that need to get kind of marked back to market. But I think we've had the time, and I think lenders have been reasonable in allowing for that recovery to happen. And there have been some highlights of some serious distress out there that have been well publicized. But there's also a lot of opportunity as a result of those as well.
Do you see the bid-ask spread getting any tighter?
Well, it probably
anytime
depends
soon?
on, it really depends on the asset.
Yeah.
It's so a have and have not world, like what Laura was talking about, that you have the main and main buildings that are probably as competitive in some cases as they were all the way back pre-COVID, let's say. And then you have others that you can't get a bid on because they're just a have not. So it varies tremendously. We had a industrial sale we closed early this year, and I was shocked to see the amount of bidders, what they were willing to do. I actually had refinanced it the year before. I was shocked on what the debt funds were willing to do because there was a loss to lease component. It was below market rent. And the old life company lender in me was shocked at all the forward underwriting. Thought we learned that lesson back in the great financial crisis, but it was reasonable, and it was they got paid appropriately. But and then we had an office trade that was similarly very aggressively sought after. The asset was one of those definite haves, but then you have others that there's a lot of well-publicized trades in San Francisco, for example, as mentioned earlier, at some really low numbers, and there's some other office markets that even if you bought it for $20 a foot, you might still lose money on that. So it's just a very have not market. And so it's hard to paint it with a general brush, kind of particularly when it comes to, the bid ask spread. The average, it's still there, but the specifics are a little different.
Mark, can you give us some expectations for the 10-year treasuries?
Oh, boy. I do a lot of forecasting, and some things I'm confident in, some not so much. This would be the not so much, but my sense is that the 10-year, what I would call the equilibrium 10-year treasury yield, kind of that yield that would be prevalent through the business cycle, would be somewhere around 4.25%, 4.5%, roughly where it is. And the way I get there is nominal potential GDP growth, which is about somewhere between 4 and 4.5%. In the long run, abstracting from the business cycle, the 10-year, which is the cost of capital for the economy, should equal the return on that capital, which is nominal potential GDP. And so that's about 4.25 to 4.5. So we're there. So I think your best forecast, if you're sitting with a spreadsheet trying to do some kind of calculation, return calculation, you just assume 4.5%, going forward. Having said that, I think the risks are skewed to higher interest rates, not lower interest rates, over the course of the next 6-12 months. And that goes to a lot of stuff that's going on in the bond market. I alluded to it earlier in terms of our fiscal situation and the amount of debt that needs to be issued. And the other thing that's going on is that the holders of Treasury debt they're shifting. They're going away from price insensitive holders of debt. The Federal Reserve, for example, when it was QEing, it's now QTing. The foreign investors, the Chinese, Japanese, have historically been the largest holders. They're pulling away. The banks, they suffered pretty significantly a couple of years ago with their upside down bond portfolios when interest rates rose. So they're more cautious. And so in the breach, in the void, have come the hedge funds, and the hedge funds are rapacious, right? They're there when times are good, and they're out of there en masse when times move away from them. And then I think there's a lot of reasonable concern about, safe haven status of the United States in the context of the trade war, Fed independence, just a melange of things that make investors very nervous about, long-term, the prospects for inflation longer term. And I'll mention one other thing. The plumbing in the system feels, incredibly fragile to me. I mean, if you look at the primary dealers that, make that market, they've not expanded their balance sheets consistent with the amount of debt outstanding. This goes to capital rules and liquidity requirements. Now, there's been some changes there that should ease up the pressures, but that all this suggests that rates are going to be much more volatile going forward, which, by the way, has real implications for for things like fixed mortgage rates. But there's a risk that rates will rise, more significantly at some point here in the not too distant future. So, most likely scenario in the middle of the distribution, 4.25%, 4.5%. But if I had to take one side of that, I'd say rates are going to be higher rather than lower.
And you mentioned the Japanese pulling away. I'd like to talk a little bit about what foreign investors are doing. Mark, I'd love your input, and Mike Acton as well, on how active you see foreign investors remaining in the U.S. market, and particularly in real estate, and specifically from which countries they're remaining more or less active.
Mike, I think that's more
Oh,
to you.
okay, yeah, sure.
Okay,
Yeah.
Mike, go for
Yeah,
it.
no, foreign investors are still allocating to U.S. real estate, but they're worried and they're being cautious. Big picture, who's pulling back or hitting pause? More likely to be Canadian and Australian, I think. Ones that are still allocating, at least that we're seeing, Japan, Germany, Netherlands. But having said that, ironically enough, on the day that Moody's issued the downgrade of the U.S. debt, a couple hours before that came out, I got an email from one of our German investors saying that he had to have an answer for his investment committee about why they should invest in the U.S., not in our fund, not in that property sector that we were talking about, not with AEW. Their investment committee wanted a written response from us on why they should consider putting capital at risk in the United States. I've been at AEW 35 years, never heard anything like that before. We wrote what I thought was a good response. Actually, used some of the same verbiage that Moody's had put in their downgrade memo, and it seemed to be satisfactory. But the whole idea that a European or Japanese or Australian investor would even be questioning putting a capital at risk in the United States sort of speaks to Mark's comments there, and I think it goes to I was on our global. We have a global allocation committee here to allocate capital around our listed strategies. When we were talking this morning, the ultimate question we're all trying to decide is the American exceptionalism trade still in place, and to what degree? Can you count on the dollar always being the strongest currency? And I think that's what all of this policy uncertainty and everything Mark talked about at the beginning is really calling into question today.
And I would just add to that, Mike, just, a small couple of basis points is a lot of capital moving in or out of the particular sector. So even if you go, hey, I'm going to round a little bit lower because I feel a little less positive, that can have big implications.
Yeah. So I don't know if Mark has anything to say about. There were some days there in April where it seemed like there was a basis point or two of credit risk being priced into treasuries.
Yeah, I mean, I'm not going to comment on the ratings downgrade.
No, of course.
Yeah, and just I didn't have anything to do with the downgrade. But,
No.
yeah.
No, just the whole
Even though I'm being
American
blamed
exception.
for the downgrade, I had nothing to do with the downgrade. Yeah.
Yeah.
Well, I do think, and I don't want to overstate the case because, you got to ask yourself the question, where does the capital go? What's that old kind of metaphor where the U.S. is a dirty shirt, but it's the cleanest dirty shirt in a pile of dirty shirts. So, it's like, but I think it's a reasonable question to ask going forward, in the context of things like, the fact that the U.S. is deglobalizing, we're disengaging from the rest of the world. And that makes the rest of the world nervous about investing in the United States and the value of the dollar. And you can see it in market action. Historically, when you have a risk-off environment, and I would suggest up until recently we were in a risk-off environment, capital flows in, interest rates fall, the dollar goes up. We saw the direct opposite that happen here. Rates went up, the dollar went down, and still hasn't recovered. So that does give you a sense that, I think the U.S. is on investors on watch. Investors, are nervous about that. And then there's other things that are going on that haven't really crystallized yet in people's thinking but I think they will. So I mentioned Fed independence. This is a big deal, and I don't think it's really, become, gotten on people's radar screen. But Fed independence, central bank independence is critical to a well-functioning market economy. It's key to keeping inflation down and interest rates low. And if we lose that, even, a little bit, that's a massive deal. And so that's going to come to the fore over the course of the next 12 months as we see changes at the Federal Reserve in terms of its leadership. So I think it's a reasonable concern, and I hear it from investors as well. But again, I don't want to make it's not like we're going to lose a reserve currency status. Not quickly, but people are searching. Why are gold prices at record highs? Why is Bitcoin at a record high? Why are silver prices at a record high? These are things that are consistent with nervousness around of the investors are having with regard to the safe haven status of the United States of America.
Does anybody else have any different thoughts? Okay, so Rob, what financing strategies are you most comfortable pursuing in today's market?
So I don't think we always have had a strategy of trying to go with portfolio lenders that are there to service loans. If things hiccup down the road, you have a little issue, you have someone to talk to. So we've generally focused on those. I think in this environment, it's been a little bit more challenging. I think the public markets are ahead of the private markets right now in a lot of ways. The CMBS market seems to be doing quite well, particularly with respect to being able to generate liquidity for office projects. And so that's been a temptation of late, and we're considering some of those options now. But I think the private debt space has expanded, evolved, grown immensely over the last, ever since the GFC, quite honestly. I mean, you could argue we were an alternative lender at one point because the yields went up so high after the GFC that a lot of our REITs looked at debt opportunities versus equity opportunities. Just because you obviously, if you can get the yield you need and take lower risk, you make that move. And I think that's driven a lot of the private debt capital and the debt funds interest. I think there's also been a lot of comfort from mainstream banks to provide the leverage to those institutions that then they can go out and do that more efficiently and tranche that risk and take the riskiest piece while the banks feel that they're adequately protected as well at a lower yield. So I think that's been a great addition to the market, particularly where there's been liquidity challenges and regulatory challenges, et cetera, et cetera. So, I for the longest time, especially in the office space, there was a sort of saying that your existing lender is your best lender. I think we've kind of started to see some transition away from that, and that there is another market out there available. It's going to start expensive. It's going to start conservative, but we're starting to see that already. And you know what usually happens, people like the yield there when they're getting beat up in multi and industrial. They're going to say, hey, maybe we should look at doing some office. We saw a lot of that at the beginning of the year as well, particularly on the life company space. And they took a fair amount of you know, select deals. And a lot of them filled up their capacity initially. And I think that yearn for yield will continue, and people will make little steps along the way, and that'll bring pricing down and hopefully availability of capital up. You know, so we feel pretty good about that. And you know, we're generally a senior debt lender. We're not a super high leverage senior plus mezz plus pref plus everything else. Keep it simple, stupid in a lot of ways, and you know, have conservative leverage levels.
Okay, just a reminder to the audience, we are taking questions. We will be going to Q&A soon. So please do submit your questions on that Q&A button. Laura, how have you changed how you evaluate investors' financial strength and their track record?
Sure. You know, for us, one of the things that I can keep coming back to is fundamentals. You know, who is the sponsorship? Where is the asset? What are the market forces impacting that asset and business plan? And for us, it's also about the expectations, being realistic expectations, both on business plan and on the amount of leverage that an investor is looking for. And so when we evaluate the financial strength and track record, it's taking all of that into account for what it is, can they execute on the business plan? For us, we are a private credit real estate lender. We focus on C-PACE financing nationwide, and we are also a servicer. So, you know, to the point about being able to pick up the phone and call someone, we're one of those people, and that's resonated with a lot of the groups we work with, that if there's a problem, happened yesterday, somebody called me and we can work through it. And so I think that certainty of execution is paramount in this market, and therefore for us, certainty of execution on the borrower side is important. So track record is important, what they can do. But for us on the PACE side, we actually the financing is tied to the asset and not to the borrower's credit or track record. So what's different about our financing is that we really underwrite the real estate. As I said earlier, you can't move real estate. You can move the tracks around it, but not actually the real estate itself. And so for us, we look at the sound fundamentals of real estate, all the things that we've been talking about. The other thing that's interesting from us is that as we look at financial strength and track record, we're lending, you know, not only for renovations and new construction, but also for refis, rescue capital, and certain distress situations. So it's looking at the short term, medium, and long term of the asset, because we are a long duration capital. It can be used short term, but people have the option of keeping us on longer to really look at the fundamentals. And then we're looking at the particular submarkets. Florida, California, Texas, New York, DC, Tennessee, Georgia, really bullish on strong states where, again, depending on what the business plan is, that the real estate itself has great metrics. You know, and I think that because we have these different purviews of short-term, medium, and long-term capital, bridge loans, refi, rescue, you know, we're seeing so many things, but it's about understanding the real estate and then figuring out what's appropriate given expectations of how much debt is on the property, whether us or others as part of that.
Rob, what new areas of investment opportunity do you see emerging in the market?
Well, that's kind of a tough one. I think it's been, I definitely think there's some opportunities in the debt space right now, because there's a lot of opportunities on the value add side. So I think that the challenge there is picking them right now in this environment with all the macro sort of volatility out there, and then with the fact that, you know, a building on this block is going to do particularly very well, like in an office to multi conversion, like Laura was talking about earlier. That building might have the great floor plate, it might have the right access, but the building across the street doesn't. So it takes some real, you know, doing your homework to really understand, back to fundamentals, to be able to make that work and understand some of those things. So it's you know, I think there is, you know, I'll probably pick on that space. I think there's a lot more talk on the conversion from office to multi. I think it's a lot easier said than done. And I think we find that's the easy solution. I'll just make it something else. Well, if people didn't want to work in that building, why do they want to live in that building? So there's a lot of those kinds of issues there. At the same time, you look at what retail did, and you had a lot of tired retail that maybe was overbuilt, that didn't really work in its location. That's a little easier conversion story, I think, in most cases than a lot of the older office product is. But that still took 4 or 5 years to kind of play its way out. It's still playing its way out, but now that's kind of, you know, maybe more of a favored property class. I wouldn't say as favored as multi and industrial, but maybe right behind it. And we're seeing lenders and capital chase that sort of proven or reproven, I'll say, sort of stability in that space. So there's a lot of opportunities there, but there's a lot of risk still out there. And I think you really, really need to do your homework. You really need to use your expertise. You know, my old credit officers and my lenders say, stick to your knitting. We're not going to venture way outside the fairway and take a gamble on something here. This is not a rising tide floats all boats kind of environment. And I think you really got to know what you're doing when you get in.
What about distressed properties? Do they represent a buying opportunity? Laura, do you have an opinion about that?
Yeah, and just also to echo what Rob was saying before, you know, it goes back to sponsorship and fundamentals and, you know, people having realistic expectations. I also think that the market's very efficient. And so to the extent that certain assets could be a Class A office building in a great location in New York, we highly sought after, whereas a Class C office building in the suburbs of pick your city might be completely vacant, and at no price will somebody come in and take the space for free. And so the price of that building might not have an ability to be repurposed. It might actually be better raised and come up with a different type of use altogether. So I think that's something we're also seeing, as taking a more refreshed view on what's realistic here for that particular asset in this market at this point in time. And I think that goes to speak to distress. A lot of it goes back to the fact that when many of these deals were created and built in this very low to 1% interest rate environment, and those construction loans are coming due now, we're seeing a number of cases where the dollars made for a construction loan, the LTC is lower than the LTV. And that's especially in the multi-space. And so the asset's not impaired. The capital markets are right now relative to where the asset was underwritten and had the initial execution. And so part of that distress is actually, in my mind, a reframing of expectations. No, you're not going to get 3%, not 300 over, but 3% financing for 80% of your asset. And, you know, in this, you know, negative leverage environment that doesn't exist. And so it's saying, okay, here's where we are, and here's where we're going to go. What are the realistic options on the table today, even if the sticker shock of some of it is really challenging? You know, whether you want to go higher in the stack, well, the question is prices or proceeds versus pricing. If you want that 85% leverage because you can't get the equity, you're going to have to pay for that. And so the question becomes, if you want your project to go forward, what does that look like? So you could think of that in some ways as distress on the construction side of missed expectation for a project that won't get to be created. We're also seeing distress on this TCO takeout. A lot of that is coming from this, as I referenced earlier, the wall of maturities, where you have assets that took longer, cost more, and now are not yet stabilized or are taking longer to stabilize. And the opportunities, maybe there was an extension for your lender. Now that extension maturity is here, that lender wants their money back. Because they need to recycle it. They're, you know, overweight office or residential, or they need to return money to investors. That's creating a bit of a stress on some of these borrowers to come up with an alternative, and that is creating distress. Now, can that be a fantastic asset? Absolutely. It's just too highly levered. And so part of this distress is thinking about, well, who are you in the stack? Are you the equity? Are you the mezz? Are you the lender? For us, we're actually coming in a number of these situations, because we're passive capital, to pay down lenders and blend and extend, and be part of a new refi to allow the asset time to stabilize. So many of these distressed assets can actually just be a function of time, as opposed to true distress of, this is a C-class office building that will never be leased, or, you know, it's an office building that's in mid-block and you never want to work there. To Rob's point, you never want to work there before. Why are you going to want to work there now? And no matter how many amenities you add, it's still dark and has, terrible infrastructure and no light, and you can't get people to come to the building. So I think it's about the perspective of what we're seeing. But I think there's solutions to that. That's coupled with realistic expectations and more of a stabilization as well, not only, but as well within the market.
Thank you. Let's turn now to some questions from the audience. And we do have a few. I want to make sure there's time to get to them. The first one that I'll ask came through while we were in the earlier stages of our conversation. So they wanted us to go back and give some specifics on what makes you expect an uptick in sales and values in the second half of this year. Whoever wants to jump in.
I will. I'll start by
Okay.
saying it kind of goes to my prior point of expectations. And you have this inflection point of a need to transact. You have a maturity. You have capital that most likely, we'll assume likely, will lend, but maybe it's not the rates you want. That's going to create an inflection point for the borrower or for the lender to do something. And so we're at that, time's up, the music stops, and you've got to find a chair. So part of that is this inflection point and the realization of the expectations. And values will maybe stabilize, maybe in some sectors, as we've all talked about, go down. But over time, as there's strong fundamentals for certain areas, I believe they will increase, because well-located office. We're in an office building. I go to the office. I like being in the office. Whether I'm in the office 3 days, 5 days, or 7 days a week, I still need space. And I want to make sure it's good space for our company to be together. And we're seeing more of a focus on people going back to the office. That's really stabilizing, where it used to be 1 to 2 days. Now, in many cases, it's 4 to 5. And there, people now seeking better space, because you want to hire good talent and retain them and make sure that they're coming into a place that feels good to collaborate.
Okay, thank you. We haven't really gotten into tariffs. We have a question asking how tariffs are going to offset federal tax deficits if they're really just a short-term stopgap strategy.
I wish we had Mark to answer that. Go ahead, Mike.
Well, that's really the open question. There's at least 2 points of view within the current administration. There's one, you might call it, say, the Peter Navarro wing, who views tariffs as a permanent new funding source. It's always been a goal of some parts of the Republican Party to have consumption-based taxes to offset some of the income tax burden, and tariffs are a form of consumption tax. So there's one part of the party that is really presenting these as a permanent financing source, maybe raising $300+ billion a year of new revenue for the government, which would go a long way to making what's in the big bill going through the House and Senate make it more palatable. But there's a whole other side of the party that's very much stressing tariffs as a negotiation point, as a tactic to get better trade deals with other countries, lower non-tariff burdens and things like that. At the end of the day, I don't think any of us know which side of that wins this argument. Mark presented an outlook that very clearly keeps the 10% across the board tariff in place, and then adds to that on selective product categories and things like that. At the end of the day, tariffs are a tax on consumption. This will be one of the largest tax increases ever passed if it stays in place. And we're a consumption-based economy, and it might have a positive revenue offset, but it comes at a cost of slower aggregate consumption.
Okay, thank you. Next question. What are the most significant repercussions possible with the administration's proposed deregulation in the banking industry? And this person specifically referenced easing of the SLR rule. If anybody wants to take that.
I'll take a shot at it. I mean,
Okay.
In general, every time you dial back some lending, so banking associated restrictions, I think it increases slightly. Maybe it depends on what the policy is, the amount of liquidity available that can be invested, and some of the ability to get to that capital. So I think from a real estate investor perspective, that's probably generally viewed as a positive for our general industry. However, as we've seen, obviously there's a downside to that too, and some of that regulation, makes it easier for bad things, bubbles to build, et cetera, to potentially happen. So it's a push and pull. I would think we've been, until maybe the last year or two, a little bit tighter on regulation as it's come, and now maybe we're loosening up a little bit. That's probably reasonably appropriate depending on what it is and the specifics, but it's generally more favorable for commercial real estate to have more availability of capital, particularly banks play in the cheaper end of the range of capital sources, and that drives returns for the mezz lender, for the debt fund, for the equity investor at the end of the day as well.
Okay. We haven't talked too much about energy impacts. Michael, maybe you could address this for us. How much do you see the energy demand supply imbalance impacting CRE goals in the near term?
Yeah, as a longtime energy investor, and I look across the sort of demand supply imbalance, it's become a pivotal factor, and it's shaping the near-term commercial real estate strategies. You look at energy-intensive asset classes, so think data centers, industrial facilities, life science campuses. There's a study by U.S. National Power demand, and basically they've looked at electricity demand accelerating. Today, I'll give you an example. Artificial intelligence is consuming 3% of all U.S. power generation today. So think data centers. By 2030, it's going to be 43%, which is pretty stunning, right? And you look at the supply struggling to keep pace. And so the commercial real estate, the imbalance, it translates to a couple of sort of near-term implications, right? Site selection is increasingly grid dependent. So look at developers. They're prioritizing locations with access to reliable, scalable power. They're co-locating with substations or even renewable hubs. Energy resilience, it's a differentiator at the margin. And you look at tenants, they're favoring properties with backup generators, battery storage, even microgrid capabilities. Permitting timelines are tightening. Projects are requiring large power loads. Those are the ones that may face delays or even a need to negotiate directly with the utilities. And if you look at valuations, very much bifurcated, and the assets with secure energy access and sustainability features could command a premium, while the others could risk obsolescence. So if you're looking at that through a lens as a long-term energy investor, real asset investor, and real estate investor, I mean, there's a whole host of things to consider throughout the sort of energy supply demand imbalance and what's going on within property types.
So let me just ask one last question with just a few more minutes to go, and just go around the room here, the virtual room. And I'd just like to ask each of you for your biggest piece of advice for involvement in the CRE market right now. Rob, I'll start with you.
Sure. Look, I mentioned a little bit of it earlier. It's just really do your due diligence, do your homework. This is not a market that every value and every property is going to go up or every cash flow is going to go up. I also think there's a lot of qualified groups that have expertise in particular types of property management, operations, et cetera, asset management, that I think this is when those groups are going to shine, because it's not, get a bunch of people together and go open a retail center or buy an apartment project. I think you need that specialty knowledge to hopefully avoid making mistakes. And even experts make mistakes from time to time. We've all got horror deal stories that, we learned something we didn't underwrite. Who would have thought COVID was that wasn't in your underwriting. So I just think it's really important to rely on the fundamentals, the location, as they used to say, way back when, and just make sure you have conviction in what you're doing right now, just because there's a lot of things outside of your control that could come and impact you. And there will be mistakes made, particularly as we're trying to figure out, for example, what's a successful office building on the margin? Is that C building converted to a B gonna make it and behave like a B plus, or is it gonna be an F and fall off the inventory list because it becomes something else? So that would be kind of the big message. I don't think it's anything revolutionary. I think we all should have been doing it for the last 15, 20 years. I think a lot of people on this panel have been. So that's just fundamentally important. Just don't get too overstretched.
Okay, thank you. We actually only have about one more minute, so maybe 20 seconds each of the rest of you. Sorry to to keep you very focused. But Mike, can you give us your thought?
Yeah, I think Rob's absolutely right. It's going to be all about growing the income of the properties. It's not about yield compression. The last two cycles, yield compression was the lion's share of the return. That isn't in the cards for today. So you got to know what you're buying and manage it well.
Okay, Michael?
Yeah, I think when you look at some of the top metro areas, if you look at industrial real estate, onshoring, some of the things we didn't touch upon, Dallas, Fort Worth, Phoenix, Columbus, Ohio, Louisville, Charleston, Birmingham, onshoring is making a difference at the margin. And there's a lot of opportunity. So I think people just need to sharpen their pencils and really spend a lot of time on research.
Great. And Laura?
Have realistic expectations. We're no longer in a zero interest rate environment. So focus on what's available today and, you know, in the near term.
Okay, great. All great advice. Well, we are unfortunately out of time. I would like to thank all of you for your participation today. To the audience, we'll be sending you all a link when the recording is available. And if you enjoyed today's session, we hope you'll be able to join us for our next CPE Voices webinar. And we also offer multifamily focused discussions through Multi-Housing News with our MHN Voices webinars. MHN also has a shorter snap session webinar coming up later this week on Thursday about EV charging. So if you're interested in that, please do register for that as well. Once again, to my speakers, thank you again for this very interesting discussion, and thanks to everybody for joining us today.
Thank you.
Thank you.
Thank you.